Hello. In this video, we'll be going through revenue-related deferred tax liabilities. For tax return purposes, when a company files a tax return, they have to calculate their taxable income and then and multiply by their enacted tax rate to get to tax payable. You would think that the income comes directly from the company's income statement that's reported on the 10K or that's just calculated for financial reporting. However, there are differences. There may be some differences between the revenue and expenses for financial reporting versus the revenue and expenses for tax. Some of those differences are temporary in nature, meaning that it's just a difference in when the revenue and expense is recorded for on the tax return versus when it's recognized for financial reporting purposes. We have deferred tax liabilities, which are recognized when activities means revenue or expenses, are reported in the current period's income statement, which means financial reporting, and will produce future taxable amounts. This means we record less revenue or more expenses for tax purposes than we do for books in the current period, but that means we're going to have to recognize those revenues or disallow those expenses in the future, resulting in future taxable amounts, that result in higher taxable income and tax payable in the future. On the opposite side, we have a deferred tax assets, which are recognized when revenue and expenses reported in the current period's income statement will produce future deductible amounts. So this means we have more revenue and less expenses for tax than we do for financial reporting, but that means in the future, we're going to have less revenue or more expenses for tax. And therefore, in the future, we'll have lower taxable income and lower tax payable. And when we record the deferred tax asset and deferred tax liability and the current tax payable, the account that makes that journal entry balance is going to go to income tax expense, which lands on your income statement. So the income tax expense is really a plug in the journal entry when you record the tax payable and the changes in the deferred tax assets and liabilities. And we use a 4-step process to do this for income tax accounting. Step 1 is always calculate the income tax payable. This means the current tax payable. This is the amount of tax currently payable based on your current year tax return. So you look at your taxable income multiplied by your enacted tax rate. That's going to be your current tax payable, and that's a liability. Step 2 is you're going to calculate your ending deferred tax asset and deferred tax liability. And then step 3 is you're going to take the change between your beginning and ending deferred tax asset or deferred tax liabilities, and you're going to record that change as a debit or credit, depending which way it goes. And then the final step, step 4, is now you've recorded your taxes payable, you've recorded your deferred tax asset or liabilities. So step 4 is going to be you have to plug that journal entry to income tax expense. I've said this before, I'll say it again. When we have changes in deferred tax assets and liabilities, usually the journal entry should go to income tax expense. There are circumstances where they might not, but for an intro to accounting, to income tax accounting, within intermediate accounting, this is what we're going to assume, that always goes to income tax expense. Now, the temporary differences, as I said before, are one kind of difference for tax return purposes where the revenue and expenses get recognized at different times between financial reporting and tax. But at the end of the day, they will equal. It's just a different periods. And there's 4 different types of temporary differences, and we have a video dedicated to each one of these. And this video is specifically for revenue-related deferred tax liabilities. So what do we mean? These are revenue items that cause deferred tax liabilities. So what this means is that for revenue for GAAP now, GAAP is financial reporting. So for financial reporting, we have revenue, right? That's income. But for tax, we're going to tax later. We're not going to recognize that revenue in our current period. We're going to recognize that revenue later in the future. And when we recognize that later for tax purposes, we're going to have to pay tax on it. So we have a future taxable amount, and we will have to record a deferred tax liability for that amount. Let's look, there's a couple of examples where you have revenue-related DTLs. If you have accrual basis sales for financial reporting and on the installment basis, cash basis for tax purposes. So tax is more like a hybrid between accrual and cash basis. So sometimes we recognize income and expenses for tax based on the accrual method, and sometimes it's based on the cash basis. And so for installment sales, it's based more on the cash basis, whereas for financial reporting, it's always based on the accrual basis. And you can have also unrealized gains from recording investment at fair value. If you took this, the first part of intermediate accounting, there was a whole chapter dedicated to investments, and investments are trued up or down. Certain investments are trued up or down to fair value, and that gain might go on the income statement. Well, so that would be revenue for GAAP now, but for tax purposes, a gain is only recognized when the asset is actually sold. So we would reverse that revenue for tax purposes and record it, whenever that asset, the investment was actually sold. So that's just another example of revenue-related deferred tax liabilities. Let's go through an example. Medina Land Management reported pre-tax accounting income in 2027, 28, and 2029 of $180 million, $100 and $100 million respectively, which includes, in 2027, that includes income of $80 million from installment sales of property. However, the installment sales are reported on a tax return when collected, which is 2028. They collected $20 million in 2028, and they collected $60 million in 2029. The enacted tax rate is 25% each year. So the information we're given here is the pre-tax accounting. And I've laid this out here like this. So we're told pre-tax accounting income is 180, 100, and 100 for each of those years. So total is 380 million. We're also told that for financial, remember, this is all financial reporting. This whole section right here is all financial reporting. For financial reporting, we recognized there's revenue included in this $180 million, right? This is after the revenue for the installment sale. My messy writing. So if you so the installment sale income recognized for financial reporting is 80 million. So if I'm looking at my installment sale income before installment sale was $100 million, right? And then they had plus 80 to get to 180. So my income before installment sales for each of the years was $100 million, but we're going to start with our pre-tax accounting income. So what we're going to do is, for tax purposes, right? So now we're starting with our pre-tax accounting income as our first line item. That's how we always start to calculating our taxable income. We start with our pre-tax accounting income, okay? So for 2027, I started with 180, but I'm going to reverse it because I'm only going to recognize that revenue for tax purposes when the cash is actually collected, which we are told is going to be 20 million in 2028 and 60 million in 2029. So in 2027, I'm going to reverse the $80 million that's included in this 180. So my temporary difference for 2027 is a reversal of $80 million of revenue. So my taxable income is 100 million. So I just want to show you, let me just erase this real quick, that My pre-tax accounting income is 180, but my taxable income is 100. So it is lower in the current period, right? The current period being 2027. And then in 2028, we're going to recognize, that's when we're going to recognize this income, when the cash is actually received. So in 2028, I have my pre-tax accounting income of 100. The installment sale for financial reporting purposes is 0 because it was all recognized in 2027. But I'm going to recognize $20 million of revenue on my tax return. And so my taxable income is going to be $120 million. So it's going to be higher than the pre-tax accounting. My pre-tax is 100. My taxable income is 120 million. Same thing for 2029. We start with pre-tax accounting income of 100. There's no adjustment for the installment sale for financial reporting because it's all reported in 2027. And I'm going to add $60 million of revenue for tax purposes because that's when we receive the cash. So the taxable income is 116 million. So the taxable income is higher in 2029 than the book income. But at the end of the day, because these are temporary differences, which means just the timing of when that revenue is recognized is different for financial reporting versus tax. At the end of the day, we have pre-tax accounting income of $380 million for the 3 years in total and $380 million in taxable income for the 3 years in total. So let's do a 2027 calculation. We're going to start with our pre-tax accounting income of $180 million. We're going to reverse that installment income, that revenue. And so our taxable income is 100. Our enacted tax rate is 25%, which gives us a tax payable of $25 million. So step one is recording your income tax payable, credit income tax payable, $25 million. Step two is figuring out your ending deferred tax liability. Your ending deferred tax liability is going to consist of any future taxable amounts that you know about, right? So in this situation, we're told that we'll have 20 million and 60 million respectively for each of the next 2 years. So we have $80 million of income that we will recognize in 2020 and 29. Always, always, always tax affected. So the 80 million times 25% is $20. So our ending deferred tax liability is $20. We're going to have a future taxable amount of $20 as of 12/31/2027. And you're going to take your change to step 3 in your deferred tax liability, which is we start with 0 balance. So our full ending balance is our credit. So we have a credit to deferred tax liability for $20. And then our plug is going to be to income tax expense. So we're going to debit that account for $45. Let's go move on to 2028, see what happens there. Pre-tax accounting income is 100. Now we have to recognize for tax purposes the cash we received of $20 million. So our taxable income is $120 million. And after tax rate is 25%. So our taxes payable for 2028 is $30. So we're going to credit step 1, credit income tax payable, $30. Step 2 is going to calculate the ending deferred tax liability. Well, remember, when we do deferred taxes, it's just the amounts. We're just looking at future amounts. Okay, so now since we're recording the current payable for 2028, there's only 1 year remaining in the future for this particular item. So we're going to recognize $60 million of income in the future in the next year. Always tax affected, so that's going to be our ending deferred tax liability, the 60 million times 25%. Our ending deferred tax liability should be $15 million. Our beginning from 2027 was $20. 2028 is 15, which results in a debit to deferred tax liability of $5. And then step 4 is our plug to income tax expense. So to make this journal entry work, we have a debit income tax expense, $25. Let's move on to the last year, 2029. Our pre-tax accounting income is 100. We've received $60 million of cash, so we recognize that full revenue for tax purposes. So our taxable income is $160 million. Our enacted tax rate is 25%. So our current income tax payable is going to be $40, and that's a credit. Step 2 is going to be calculate your ending deferred tax liability. Well, now we have nothing in the future related to this particular temporary item. So our ending deferred tax liability should be 0. Our beginning from 2028 was 15 million. Our ending is 0, so we need a debit to deferred tax liability of $15 to make that happen. And step 4 is going to be our plug to income tax expense, debit $25. This is a T account view of the deferred tax liability account, taking you from the beginning balance of 0, setting up the deferred tax liability for $20, and then we debited $5 and $15 for each time we collected that installment sale in cash. And so our balance is 0 after 3 years. So let's go to a concept check. Shortly before the end of 2027, Coulter Company makes an installment sale that generates $400 of before tax income. That's the same thing as pre-tax income. Coulter recognizes income for accounting purposes when the sale is made, but will recognize income for tax purposes when cash is subsequently collected in 2028. Coulter has a tax expense rate of 25%, and we have to figure out what Coulter's 2027 tax expense journal entry would look like. So just for this, usually we say calculate the, step 1 is calculate the current tax payable, but we don't have that information here. So we're going to go step 2, and step 2 is calculate your ending deferred tax. Well, first, before we calculate deferred tax, we say, is this a deferred tax liability or is it a deferred tax asset? So we look at the facts and we say, we'll see that Coulter recognizes income for accounting when the sale is made in 2027, but they're going to recognize it for tax when in 2028. So we have less revenue in the current year for tax, but we're going to recognize that revenue in the future in 2028 for tax purposes, which is going to make our taxable income higher in 2028 and therefore making our taxes payable higher. So we have a future taxable amount. So we know we're going to record a deferred tax liability, and it's for $400, but we always have to tax affect it. So $400 times 25%, our ending deferred tax liability is $100. So there's our credit to $100 because our beginning is 0, so the change is 100. And since we're not told what the taxes payable are, it's just letting you, we're just going to put the other side of this entry, the whole amount to income tax expense. And see how it says to balance? That just means it's the plug. So in this situation, Coulter's 2027 tax expense journal entry would include what? It would include a credit to deferred tax liability of $100. It could have also asked you what the balance was, what the entry was to income tax expense. Again, look at these choices, that there's also, look at choice B, is a credit to deferred tax liability for $400. This is very tricky. You always have to remember to tax affect your numbers when we're talking about income tax accounting.